Hello, everyone. So, moving on with chapter 8, we finished off the first section today, just talking about whether you can handle as much risk as you want, the different types of risk, what to consider, and now just going into more of that and also different investment options. So, we kind of just said a broad what is investing, safety versus risk, and now we're going to go right into now that you're deciding that you want to invest and you set up your emergency fund, what investments are out there for you to look into. And we're going to talk about these four alternatives: stocks, bonds, mutual funds, and real estate. So with stocks are shares, that's what they're called, of ownership in a company to provide them with operating funds. So you buy a share in a company and you become a owner because you are buying ownership, although it's 0.0001, very, very small percentage of ownership, you're technically an owner of that company. And the company receives the money that you invest in from giving you their stock. And with that money, that helps them with their operating funds, different things that they need to spend money on. They get them that money from everyone who buys stocks. Those of you who maybe have done simulation stock market games, you have an idea of what I'm talking about. So with stocks, you're buying shares of ownership of a company, you become part owner of a company, and you're hoping that the value of your stock increases over time. And if you bought it at, say, $50, you eventually can sell it at 100, 150, $200 a share. There's two different types of stock. There's common stock, which you are allowed to have voting privileges. So say there's a change in CEO, a change on the board of directors, you can vote because you are technically an owner. And there's also preferred stock. And with preferred stock, you're given dividends. And that's small amount of money that the company gives out to you if you have preferred stock in their company. No matter how the company is doing, even if they're doing poorly, okay, they give out dividends. So if you are preferred stock, you get dividends. Right now, Apple is about 50 cents, 52 cents a share in dividends, which may not sound a lot, but if you own 50, 100, 200 shares of Apple, multiply that by 50 cents, and it's a nice little bonus on top of hopefully the increase in value of the stocks that you bought. So you're basically comparing voting privileges, if you prefer that, or dividends. Most people, I would prefer personally dividends. So that's stocks. Now bonds. Bonds are essentially a corporation's or government's pledge to repay you the money that you give them plus interest. And these bonds are used for, say, buildings, other types of expensive, you can say, plans that they have and they need money. So instead of giving out shares, okay, because usually this is from either a company or the government, okay, they'll issue out bonds. Then what happens is you buy the bond, the government or that company gets your money, and you hold on to that bond. And over time, when the bond, what we say, matures, okay, the maturity date is either you're holding on to that bond for either a year all the way up to 30-year bonds, okay, up to 30 years. And then throughout the time, you'll get your money back plus interest, okay? And especially investing in government bonds, bonds are usually a lot more safer. Remember when we talked safety and risk than stocks, because with government bonds, of course, they're backed by the government. So when you want a safe investment, bonds are the way to go. If you want more of a risky investment, you would look towards stocks. Stocks do give you a higher reward generally, where bonds don't, but depending on how much you're investing and your asset allocation. So we have stocks, we have bonds. Next, we have mutual funds. All right, mutual funds, it's a fund that you could think of consists of many stocks. And it can consist of many stocks, many bonds, or a combination of the both. These are really good for inexperienced investors who don't want to buy and sell stock by stock by stock. You invest in a mutual fund, which is a portfolio of stocks, portfolio of bonds, and a fund manager makes the decisions of what's in your fund. But it's really good to say if you have a mutual fund, and that's what I invest in personally, of let's say 20 companies, if company A and B aren't doing so well, okay, the other companies can pick it up and kind of neutralize that loss. Where if you just invested in company A and company B and only in those companies, you're stuck and your investment is going to lose its value and you may end up losing money there. All right. So mutual funds. And lastly, real estate. You may have family members who own real estate or own a separate house and may rent it out to people. That's an investment. Or you may know people, and I know of some of my family where they buy property, they buy houses, they fix them up, redo the kitchen, redo the bathrooms, and then they try selling it at a higher price, called flipping, you can say, and they make a profit. So you either buy it and flip it, or you can buy it and rent it out. So those are really are four alternatives. A big thing when investing is what's called diversification. This is the biggest part and one of the biggest ideas I want you to remember. Diversification is spreading your assets, your cash, amongst different types of investments. Okay, you just don't want it all in stocks. You just don't want it all in real estate. You want to have a really good balance. All right, that terminology, don't put all your eggs in one basket. Well, this is the prime example. And here I give you the investment period, the different levels you want to go through. We all want to start off at, well, you should start off at level one, which is financial security, having enough in cash, a savings account, bonds where they're very low risk and your money is generally safe. Then once you have a good amount level one, you can move up to level two, which is safety and income. We're talking company bonds or corporate bonds, utility stocks, different types of securities that we're not going to touch on to. And then you want to go on to level three, which is growth. And we're looking at growth stocks, mutual funds, real estate here. And then level four, which is speculation, the highest of risk, looking at speculative stocks, collectibles we talked about in class. So you want to go level by level by level. And you can see the sizes of each triangle in the pyramid is you don't want to have a lot in level four. You want to have most of your money in level one, a good amount of money level two, and continue up the pyramid. So a really good pyramid to follow, depending on, once again, what your goals are and how can you handle risk. That's all a personality check that you have to decide on when you decide on investing. This table we're going to complete in class. So we will get to this kind of a recap from this section. That will be our part of our WSQ chat. And lastly, the money from investments. You want to look, is it tax exempt, tax deferred, or is it taxable? Tax exempt means that your money that you make, it's not taxed, which is great. A Roth IRA, for example, is tax exempt. You can have funds and investments that are tax deferred, which your money is taxed at a later date. So a 401k, a 403b for teachers, where the money that we make, it's taxed at a later date. Remember, after that 59 and a half, when we decide on withdrawing. Okay. Or is it taxable, and which is generally taxed. So kind of you want to look at the taxes and pick different funds that can help you lower the amount you pay in tax, or especially, for example, with a Roth IRA, you pay the taxes now because you're hoping that you're making more money in the future, so you're not getting taxed at a higher tax bracket that we went over today. So just an example of, I shouldn't say to not get taxed, but kind of to manage when and how much is getting taxed, and kind of manage when do you want to get taxed. That will work best for your investment goals. So a little trickier here. Types of investment income. We said our dividends, our interest income, that would be from our bonds, and our rental income from our real estate. And just want to know, capital gain is that we made money, we made profit, and capital loss is that we lost money. All right, so we'll